Hey there, curious minds. Welcome back to the Deep Dive, the place where we cut through the noise and get straight to the knowledge that matters. Today, we're taking on a topic that might sound a little complex at first, but trust me, by the end of this deep dive, you'll feel like a true financial detective. Our mission today is to crack the code of financial instruments. We're going to break down what they are, how companies classify and value them, and crucially, what that means for understanding a company's financial health. Think of it as peeling back the layers of a company's balance sheet to see the real story, identifying the hidden signals that reveal its true financial pulse.
Indeed. And we'll be navigating the intricacies of financial assets and liabilities, exploring some critical accounting choices like the fair value option, and then really getting into the specifics of debt and equity securities. Our goal here is to make every piece of this puzzle easy to understand, providing the clarity you need to grasp these fundamental concepts and truly see the underlying financial landscape of a business.
Okay, so our first piece of evidence in this financial mystery. What are these financial instruments we keep talking about? Are they just, fancy names for money, or is there something deeper here we need to uncover?
Not just fancy names for money, no,
Uh-huh.
although money is definitely involved. The concept is broader, really more foundational. At their core, financial instruments are contracts, and these contracts simultaneously create a financial asset for one entity
Okay.
and a financial liability or maybe an equity instrument for another entity. But here's the crucial insight for you. These aren't just entries on a spreadsheet. They are the promises and the obligations that truly define a company's economic relationships.
So it's about the relationship then.
Exactly. Understanding them is like seeing the hidden plumbing of a balance sheet. Who owes whom, what's expected to happen, and under what conditions. It's the real story underneath the numbers. It's a formal, legally binding agreement that dictates how resources, usually cash, will flow in the future. Hashtag 1.1.1 financial assets.
That's a great way to put it, the hidden plumbing. So if we follow that thread, what exactly counts as a financial asset? Give us some real-world examples, because that's where it really clicks for me. What are companies looking to gain or own when we talk about these?
Right. Think of a financial asset as essentially a claim check for future money or maybe other financial items. It's a formal, legally binding promise that someone else will give you cash, or perhaps you'll get to swap instruments on terms that actually benefit you.
Okay, so it's not like owning a building.
No, exactly. It's not owning a physical building or inventory. It's owning a promise of future economic benefit. Our source breaks them down into a few key categories, which I think helps illustrate the breadth of what falls under this umbrella. The first one, and probably the most straightforward, is cash. This is really the king of liquidity.
Can't get more basic than cash.
Right. We're talking about demand deposits in a bank account or maybe holding foreign currencies. It's immediately available liquid capital, it's universally accepted, and it's the simplest form of a financial asset. When you see a company with a lot of cash, you know they have immediate spending power. Then you have evidence of ownership interest. This basically refers to documents proving you own a piece of another entity.
Like stock certificates.
Exactly. The classic examples are stock certificates in a corporation, literally a piece of paper, or, well, now usually an electronic record, saying you own a sliver of that company. But it also includes things like partnership interests or stakes in a limited liability company, an LLC. These aren't just pieces of paper. They represent a direct claim on a portion of that entity's future assets and earnings. They give you a real stake in its long-term success and potentially its future profits. It's about participating in the upside.
Okay, owning a piece of the action.
Precisely. Moving on, we have a contractual right to receive cash or another financial instrument. This is where you've effectively lent money, and you expect specific repayments. Think of bond investments. You've provided capital to a corporation or maybe a government, and in return you have a formal agreement entitling you to specific regular interest payments and the principal amount back when it matures.
Like an IOU, but much more formal.
Exactly. Notes receivable, which are more formal, written promises of payment, often from customers for goods or services, or maybe from other entities for loans, they also fall squarely into this category. The key here is a fixed expected stream or lump sum of cash, or maybe another financial item that you are owed. It's a promise of future income. Finally, we have a fascinating category, a contractual right to exchange other financial instruments on potentially favorable terms.
Okay, this sounds a bit more complex.
It is. This covers more complex instruments often used for hedging against risk or sometimes for speculation. We might know them as derivatives. Imagine you have a stock option that's the right but importantly, not the obligation to buy or sell stock at a certain price within a specific time frame. Or things like futures and forward contracts, which are agreements to buy or sell an asset, like a commodity or a currency, at a predetermined price on a future date. The favorable terms aspect is absolutely key here. It implies a potential for profit from that exchange. You enter into these agreements hoping the market moves in a way that allows you to execute the exchange and gain financially. It's really about leveraging future price movements.
Got it. So you're betting on the future price, essentially. Hashtag 1.1.2 financial liabilities. That distinction between a direct claim and a right to exchange on favorable terms really clarifies it. So if assets are what you're owed or what you own, then financial liabilities must be the flip side, right? What obligations do they represent? What does it truly mean to be on the hook for a financial instrument?
You've got it. If we flip that coin, liabilities are where you're truly on the hook. A financial liability is a contractual obligation, an obligation to deliver cash or another financial instrument to a second entity,
Okay.
or an obligation to exchange other financial instruments on potentially unfavorable terms. Just like assets, we can categorize them based on the nature of the obligation, but now we're looking at what a company has to give up. The first type is an obligation to deliver cash or another financial instrument. This includes very common obligations like bond obligations,
Right.
where a company has borrowed money by issuing bonds and is now formally committed to make regular interest payments and repay the principal amount to the bondholders.
Right. Paying back the loan.
Yes, exactly. Similarly, notes payable are formal promises to pay back borrowed money, or maybe amounts owed for significant purchases. These are direct outflows of resources, a clear, often scheduled commitment to pay cash or transfer another financial asset in the future. It's the company basically saying, we promise to pay. The second type is an obligation to exchange other financial instruments on potentially unfavorable terms.
The flip side of the derivative assets.
Precisely. This mirrors the derivative examples we discussed for assets, but now from the perspective of the party who might face a loss if the market moves adversely. For example, if you sold a call option, you have an obligation to deliver stock at a certain price if the buyer exercises their right, even if the market price of the stock is skyrocketed.
Ouch.
Yeah, that means you'd likely incur a loss on that exchange, as you'd have to buy it at a high market price to sell it at the lower agreed-upon option price. With futures or forward contracts, if the market price moves against your predetermined position, you're on the hook for a potential future payment or exchange under conditions that are disadvantageous to you. It's about taking on a risk where the market could turn against you, forcing a loss. The important takeaway here for both assets and liabilities is the deeply contractual nature. It's not just a casual promise or some loose understanding. It's a legally binding agreement.
That legal bit seems really key.
It is. It dictates future financial flows and obligations. This contractual foundation is what distinguishes financial instruments from other types of assets and liabilities. It means there's a formal, enforceable claim or obligation that has really profound implications for a company's financial future.
That contractual foundation is crucial. Now, let's talk about something that gives companies a bit of a strategic choice in how they present their finances. This is where it gets really interesting, I think. The fair value option. It sounds like it offers incredible flexibility, but what's the core idea behind it, and why would a company choose this path?
Right. The fair value option, or FVO as you'll often hear it called, is indeed a strategic choice. It's almost like a special lens companies can decide to apply to certain financial items. It allows entities, but only on specified election dates, mind you, to choose to measure certain eligible financial instruments at fair value, even if the standard accounting rules wouldn't typically require it for that instrument.
Okay, so they opt into using market value.
Exactly. And the key impact, the thing that makes it so interesting for financial reporting, is that any unrealized gains and losses, those changes in the instrument's value on paper before it's actually sold, are reported directly in the company's earnings.
Straight to the income statement.
Straight to the income statement, affecting net income immediately. Now, this choice, once made for a specific instrument, is generally irrevocable. You can't just flip-flop back and forth.
So it's a commitment.
It's a very precise and impactful decision. Hashtag tag 2.1 eligible financial instruments.
So if it's such a powerful option, are there guardrails? What can and can't use this option? Are there specific types of financial tools this applies to, or is it a broad brush?
Good question. You're right, there are very specific rules about eligibility. Companies can elect the fair value option for recognized financial assets and financial liabilities, for instance. An entity might choose to measure a debt investment at fair value. Normally, if this debt investment were classified as available for sale, and we'll get into that classification later, its unrealized gains and losses would go to something called other comprehensive income, or OCI. It sort of bypasses the immediate income statement hit.
Right, we mentioned OCI earlier.
But with the FVO, those paper gains and losses go straight to earnings. This creates a very different, often more volatile picture of profitability for that period. Similarly, an entity could choose to measure an equity investment at fair value that would otherwise be accounted for using the equity method. The equity method is used when you have significant influence over another company, and it involves reflecting your share of their income, not just the stock price ups and downs.
Okay.
The FVO lets them show that market value volatility directly on their income statement instead. However, and this is important, not all financial instruments are eligible. The source specifies several important exclusions. These include investments in subsidiaries or variable interest entities, VIEs, that an entity must consolidate, basically. Companies they control and whose financials are merged into their own.
Makes sense. That's a different relationship.
It's exactly. Also excluded are pension benefit assets or liabilities, financial assets or liabilities recognized under leases, deposit liabilities of financial institutions, and financial instruments already classified as equity on the company's balance sheet. These exclusions often stem from the fact that these items are already accounted for under very specific, often complex rules. The FVO isn't intended to override those. They have their own detailed frameworks, and applying the FVO would probably just complicate things rather than simplify their presentation. Hashtag tag 2.2 fair value changes attributable to instrument-specific credit risk. Now, here's a subtle but very important nuance, particularly for financial liabilities when you use the fair value option. For financial liabilities other than derivative liabilities, if their fair value changes because of a change in the company's own credit risk.
Wait, the company's own credit risk, how does that work?
Yeah, it sounds a bit counterintuitive, but think about it. If a company becomes less likely to pay its debts, its bonds might actually become less valuable in the market. Their fair value decreases. Now, if you're measuring a liability at fair value, a decrease in its value is technically an unrealized gain.
Yeah.
It makes the liability smaller on your books.
So you look more profitable because your own credit got worse. That seems weird.
Exactly.
Huh.
It is weird, and that's why there's a special rule. That portion of the fair value change specifically due to the change in the company's own credit risk is recognized in some other comprehensive income, OCI.
So it bypasses the income statement.
Right. It prevents that potentially misleading result on the income statement. It avoids making a company look more profitable just because the market thinks it's riskier. However, for derivative liabilities, these changes are recognized in net income. That reflects their more immediate market impact.
Okay, so a different rule for derivatives.
Yes. This distinction is critical for understanding a company's profitability and how different types of liabilities are treated under the FVO. And then, once the financial liability is no longer recognized on the books, maybe it's repaid or settled,
Right.
any accumulated gains or losses related to that credit risk that were sitting in OCI are then moved or recycled and recognized in earnings.
So it all ends up in earnings eventually.
Eventually, yes. But the timing is carefully managed based on the source of the fair value change, whether it was market factors or the company's own credit standing. Hashtag tag 2.3 election dates. And as I mentioned, companies can't just elect the fair value option whenever they feel like it. The source outlines specific election dates. This ensures consistency and prevents, opportunistic accounting choices.
Right, you can't just pick the method that makes you look best this quarter.
Precisely. These are logical points in an instrument's life cycle or the company's relationship with it. For instance, the option can be applied when an entity first recognizes an eligible financial instrument, sets the accounting treatment from day one. Another election date is when an investment becomes subject to the equity method of accounting, which signifies a change in the investor's influence. And finally, when an entity ceases to consolidate an investment in a subsidiary or VIE, as this also represents a significant change in the nature of the investment. These specific dates ensure that the election is made at logical points, providing a structured framework for applying the FVO. It's about setting the rules of the game up front.
All right, we've laid the groundwork with the broad definitions and that really interesting strategic choice companies have with fair value. Now let's zoom in on specific types of financial instruments, starting with debt. So what does this all mean for how companies account for debt, and how does it actually play out in their financial statements? Hashtag 3.1, what are debt securities?
Okay, debt securities. Essentially, any security that represents a creditor relationship with an entity. Think of it as proof that one entity has loaned money to another and expects to be repaid, usually with interest. It's about being owed money, not owning a piece of the company directly. You're a lender, not an owner in this case.
Like lending money to a friend and getting an IOU, but, much more formal, often interest-bearing with specific terms, conditions, and usually a public market for that IOU.
Exactly, a much more formal IOU. Our source gives us clear examples of what is a debt security, which helps define the scope. These include things like corporate bonds, those formal loans made to a corporation, also redeemable preferred stock. Now, it has stock in the name, which can be confusing.
Yeah, that sounds like equity.
It does. But if it must be redeemed by the issuer, it actually behaves more like debt because the holder has a right to be repaid a principal amount, similar to a loan repayment. Then you have government securities, like U.S. Treasury bonds or municipal bonds, loans to governmental entities. Convertible debt, these are bonds that can be converted into a specified number of shares of common stock, but until they're converted, they function primarily as debt instruments.
Okay, so debt until proven otherwise.
Pretty much. And also commercial paper, short-term, unsecured promissory notes issued by corporations, typically for financing very short-term needs like accounts receivable or inventory. It's also really important to note what debt securities do not include, just to avoid confusion.
Right, the exclusions.
They don't include options, futures, or forward contracts. Those are derivatives, right? They're financial instruments, but they're rights to exchange rather than direct creditor relationships representing a principal amount loaned. Also excluded are lease contracts, which have their own specific accounting rules about the right to use an asset, not a loan of money. And standard accounts and notes receivable that arise from, say, selling goods on credit. Those are typically part of a company's day-to-day operations and trade credit, rather than strategic investment securities. These exclusions are key because their accounting and purpose are fundamentally different. Hashtag 3.2 classification. It's all about intent.
This is where the why behind holding a debt security becomes super important, isn't it? It's not just what the security is, but why a company holds it. This intent determines how it's classified, and therefore how it's accounted for on the financial statements. Tell us about these three key categories and how a company's purpose drives the accounting. This sounds like a critical piece of the puzzle for our financial detectives.
You've hit the nail on the head. The classification of debt securities is indeed driven fundamentally by the company's intent. There are three main categories, each with distinct accounting implications, and understanding these tells you a lot about management strategy for these investments. First, trading securities. These are debt securities that a company buys and holds principally for the purpose of selling them in the near term.
Like a day trader.
Exactly.
Yeah.
Imagine a company that's essentially acting like a trader, trying to capitalize on small, quick market movements. Their main objective is generating profits from short-term price fluctuations. Because of this rapid turnover intent, trading securities are generally reported as current assets on the balance sheet, reflecting their liquidity and the company's expectation to convert them to cash soon. They're really part of the company's active profit-seeking operations. Next, we have available for sale, AFS, debt securities. This is basically the catch-all category. If a debt security doesn't fit the strict definition of a trading security, meaning it's not held for immediate resale, or a held-to-maturity security, meaning there isn't a definite intent and ability to hold it until it matures,
Got it.
then it defaults to available for sale. The intent here is that the company might sell them before maturity, maybe if a better investment opportunity comes along, or if they need liquidity, but it's not the primary short-term objective of profiting from quick price changes. Because of this sort of intermediate intent, AFS securities can be reported as either current or non-current assets, depending on the company's specific plan regarding their potential sale within the next year or beyond. It's kind of a strategic bucket for flexible investments.
So they're available just in case.
Pretty much.
Yeah.
Finally, held to maturity, HTM, debt securities. Investments in debt securities are classified as HTM only if the corporation has the positive intent and ability to hold these securities to maturity.
Yeah.
This is a very strict criterion. It requires significant management judgment and also demonstrable capability, like do they actually have the financial stability to hold it that long?
It's not just wishing they could hold it.
Not at all. If the intent is just to hold for an indefinite period, but not necessarily until the exact maturity date, then it must be classified as AFS. Furthermore, if there's any scenario where the security could be settled, such that the holder wouldn't recover substantially all of their investment, maybe there's significant credit risk or some complex embedded option that could wipe out principal, then the HTM classification just isn't allowed. Too risky. HTM securities are reported as current or non-current assets based on their time remaining until maturity, much like how other fixed assets are classified. This intent aspect is just critical. It's not just about what the security is, but what the company plans to do with it, and that plan dictates the entire accounting treatment.
And that directly influences how gains and losses show up.
Absolutely. It determines where they appear on the financial statements, giving investors a powerful signal about management strategy for these investments. Are they looking for quick profits, long-term stability, or something in between? The classification tells you a lot. Hashtag tag 3.3 valuation, how value changes are reported.
That's a huge insight. So how do these different intentions trading, available for sale, held to maturity, actually change how the value of these investments is shown on a company's financial statements? This is where the rubber meets the road, right? Impacting reported profits and balance sheet values, and where our detective skills really come into play.
Exactly. The valuation method is a direct consequence of that classification. Let's start with the securities reported at fair value. Debt securities classified as trading and available for sale must be reported at fair value. Fair value is essentially the current market price, right? What a willing buyer and seller would agree upon. When this fair value changes from one reporting period to the next, it results in unrealized holding gains or losses.
Unrealized meaning paper gains or losses.
Exactly. Yeah. The security hasn't actually been sold yet, so the cash hasn't changed hands. While companies might keep track of the original cost and maybe a separate valuation account to show the adjustment, on the balance sheet itself, it's ultimately presented as one net amount, reflecting that current fair value. Now, for unrealized gains and losses on trading securities, this is where the market's daily pulse directly impacts a company's reported profits. These unrealized gains and losses are included directly in earnings, hitting net income immediately. Right. This reflects their short-term, profit-seeking nature. The accounting recognizes that the company is actively trading these, so their value fluctuations are considered part of the current period's operational performance. So if a trading security loses value, that paper loss immediately shrinks the company's reported profits for the period, even if they haven't actually sold the security yet.
So if you're holding trading securities, your profit and loss statement can jump around quite a bit just from daily market movements, even if you haven't sold anything yet. It makes the earnings really sensitive to market volatility, which is something an investor would absolutely need to know.
Absolutely. Now here's the crucial distinction for unrealized gains and losses on available for sale debt securities. For AFS securities, unrealized holding gains and losses are recognized in other comprehensive income, OCI.
OCI again, not net income.
Not directly in net income. OCI is a separate component of equity, kind of like a holding pen for these fluctuations, not part of the income statement itself. This means these paper gains or losses don't immediately affect the company's reported profit for the period. This treatment reflects that the company doesn't necessarily intend to sell them quickly, so their market fluctuations are seen as a broader change in equity rather than a direct hit on current earnings. It presents a more stable picture of operational profit, potentially.
This is a big aha moment. So for AFS, the ups and downs of the market are shown, but they don't hit your bottom line in the same way as trading securities. It gives a different picture of volatility to investors, maybe making earnings seem more stable, even if the underlying assets are fluctuating in value. That's a key distinction when you're analyzing financial health.
Precisely. And just to be clear, regardless of classification, realized gains or losses are recognized when a debt security is actually sold. So once the transaction occurs, cash changes hands, the gain or loss becomes realized.
Okay, realized means sold.
Right. For AFS securities, a realized loss is also recognized if the security is deemed impaired, meaning a permanent decline in value has occurred. All realized gains or losses, whether from a sale or an impairment, are ultimately recognized in net income. That's the definitive profit or loss from the investment for that period. Now, for held-to-maturity debt securities, the accounting is completely different. They are reported at amortized cost.
Amortized cost, meaning not market value.
Correct. They are not marked to market at the end of the period. Their value doesn't fluctuate on the balance sheet based on current market prices. Instead, they are initially recorded at cost and then adjusted over their life for any premiums or discounts paid, basically smoothing those out to adjust the effective interest rate. As a result, unrealized gains and losses on held-to-maturity securities are not recognized in the financial statements at all.
Not at all.
Not at all. They are completely ignored from a reporting perspective until the security matures or is maybe sold before maturity, which should be rare for HTM.
Why no unrealized gains or losses for held to maturity? It seems like ignoring market movements. Is it because the company genuinely intends to hold them until they mature, so those short-term market price fluctuations aren't considered relevant to their long-term value to the company? What's the core philosophy there?
That's precisely it. The rationale is, if a company has both the positive intent and the ability to hold a debt security until its exact maturity date, then any temporary fluctuations in its fair value are, well, largely irrelevant to that company's financial position or performance from their perspective. The company fully expects to receive the principal and interest payments as contracted, regardless of those interim market prices. So, reporting those unrealized gains or losses would just add noise to the financial statements, potentially obscuring the company's true long-term investment strategy for these holdings. It reflects a very stable, long-term approach to investing in debt. Hashtag 3.4 reclassification when intent changes.
What if a company changes its mind? Let's say they initially intended to hold a bond to maturity, but then circumstances change. Maybe they need cash urgently or a much better opportunity comes along. Can they reclassify it, and how does that affect the financial statements and the picture they present?
That's a great question, and it really highlights the dynamic nature of financial management. Transfers between these categories should indeed be rare. They should only occur when justified by a significant, demonstrable change in circumstances or intent. For instance, a transfer from the held to maturity category should only happen if there's a demonstrable and significant change in the entity's intent to hold that specific security to maturity. And importantly, this change shouldn't call into question their intent for other HTM securities in their portfolio. Otherwise, it might suggest a broader change in strategy that could sort of taint the HTM classification for all their holdings, possibly leading to more widespread reclassifications.
So changing your mind on one could impact others.
It could, yes. The standard is high. Transfers to and from the trading category should also be rare, just given their inherent short-term active nature. Now, when a transfer does happen, the security is accounted for at its fair value on the date of transfer. The accounting for any unrealized holding gain or loss at that point depends on the categories involved, and yeah, it can get a little intricate. First, if security is transferred from the trading category, well, any unrealized gain or loss was already recognized in earnings as it occurred, right?
Right. It already hit the income statement.
So no adjustment or reversal is necessary on transfer. It's already kind of baked in.
Mm.
Second, if a security is transferred to the trading category, any unrealized holding gain or loss at the transfer date must be recognized in earnings immediately. This reflects that it's now being held for immediate resale, so its fair value fluctuations are considered part of current period earnings, just like any other trading security.
Okay, immediate income hit.
Third, if a held-to-maturity security, which was valued at amortized cost and had no recognized unrealized gains or losses, is transferred to available for sale, which is valued at fair value, the unrealized holding gain or loss at the date of transfer is reported in other comprehensive income, OCI.
Into OCI, like other AFS unrealized amount.
Exactly. It's consistent treatment for its new home.
Yeah.
And finally, if an available for sale security whose unrealized gains losses were already sitting in OCI is transferred to held at maturity, the unrealized holding gain or loss already reported in OCI is not reversed immediately.
Oh, what happens then?
Instead, it is amortized over the remaining life of the security. This amortization acts as an adjustment of the yield, similar to how bond premiums or discounts are amortized. It sort of smooths out the impact on earnings over the remaining life of the bond, recognizing that its intent has now shifted to being held for the long term. It's a way of slowly bringing that OCI balance into net income over time. Hashtag 3.5 income from investments in debt securities. This part is relatively straightforward, thankfully. Interest income from an investment in debt securities, whether it's classified as trading or available for sale, is recognized directly on the income statement.
Okay, interest is income.
Pretty much.
Yeah.
It just reflects the periodic interest payments a company receives from holding these debt investments, boosting their reported revenue. For held-to-maturity securities, the interest income is also recognized in net income, but it's often calculated using something called the effective interest method. This takes into account the amortization of any premium or discount paid when buying the bond, ensuring the true yield is accurately reflected over the bond's life rather than just the stated coupon rate.
So slightly different calculation, but still hits the income statement.
Correct. So regardless of category, the regular cash flow from interest hits the profit and loss statement. Hashtag 3.6 impairment of debt securities when things go bad.
Okay, this is where we talk about when an investment might lose its value permanently. It's a challenging topic, I imagine, but absolutely crucial for understanding risk and how a company accounts for potential losses on its investments. Tell us about impairment for debt securities. How do companies recognize that a bad debt might be on the horizon?
You've hit on a critical point for any financial detective anticipating trouble before it fully hits. Under the current expected credit losses model, often called CECL,
CECO, right?
both available for sale debt securities and held-to-maturity debt securities should be reported at the net amount expected to be collected. This is a really important forward-looking approach. Companies have to estimate potential losses before they actually occur, based on their best judgment of future collection possibilities. This net expected amount is determined using an allowance for expected credit losses.
So they set aside a reserve, essentially.
Kind of, yes. An allowance account. These expected credit losses are estimated based on current conditions, past experience with similar instruments, and crucially, future expectations about the borrower's ability to pay. A credit loss is recognized as a current period expense on the income statement, directly impacting profitability, and it's recorded as an offsetting allowance on the balance sheet, which reduces the carrying value of the investment. Importantly, increases and decreases in expected credit losses are reflected on the income statement in the period they occur. This makes the financial statements much more responsive to changes in credit quality. It's about being proactive about potential defaults.
So it's not just waiting for the borrower to default. It's about making a best guess today about what might go wrong in the future and adjusting the books for that possibility right now. That's a significant shift. Hashtag 3.6.1 impairment of held-to-maturity securities.
Okay, let's look specifically at impairment of held-to-maturity securities. If it's determined that all amounts due, both the principal and the interest, will not be collected as originally contracted, the investment is then reported at the present value of the principal and interest that is expected to be collected.
Okay, the present value of what they think they'll get back.
Exactly. The credit loss, which is the amount recognized as an expense in the income statement, is the difference between this calculated present value of expected future cash flows and the original amortized cost of the security. It's an immediate hit to earnings when the company foresees a shortfall. Let's walk through example 1 to make this concrete, focusing on the impact rather than getting bogged down in every single number. So the facts. TGPOCO bought a $500,000 bond, classified as HTM. At the end of year 3, they figure out they're probably not going to get all the future interest they were promised, only about $11,500 per year, instead of the original $21,250, though they still expect the $500,000 principal back.
Okay, bad news on the interest payments?
Right, so the solution involved figuring out the present value of the cash TGPO now expects to receive those reduced future interest payments plus the principal. After calculating the present value using the appropriate factors, we find the total expected present value is $473,073. The bond was on the books at its amortized cost of $500,000. So the difference between what was on the books, $500,000, and the present value of what they now expect to collect, $473,073, is a credit loss of $26,927.
And that hits the income statement.
Yes, this $26,927 is recognized as an expense on the income statement, directly reducing TGPO's reported profit for the year. And an allowance account is set up on the balance sheet to reflect this anticipated shortfall.
This really shows the immediate impact when a company determines it won't get all its money back, even if they haven't sold the bond yet. It highlights the importance of constantly assessing credit risk and updating estimates, directly affecting the company's profitability and reported asset values. It's almost like a penalty for perceived future bad news hitting today's results. Hashtag 3.6.2 impairment of available for sale debt securities.
Now, impairment for AFS securities is accounted for differently than for HTM. Why? Because the investor always has the option to sell the AFS security. This means that the current market value or fair value of the security plays a critical role in how impairment is recognized.
Ah, because they could just sell it if things look bad.
Exactly. As a result, the credit loss reported in net income on an AFS security is limited to the amount by which its fair value is below its amortized cost. Any additional loss beyond that limit, essentially, the portion of the fair value decline that is not considered attributable to expected credit losses, but maybe just due to overall market conditions or interest rate changes, that part is reported as an unrealized loss in other comprehensive income, OCI.
So the loss gets split, potentially.
Potentially, yes. This distinction is crucial. It separates losses specifically due to a borrower's credit issues, which hit net income up to the fair value decline, from losses due to broader market shifts, which go to OCI. It gives a more nuanced picture. Let's use example 2. Same bond details as example 1, but this time it's classified as AFS. We still have that underlying expected credit loss of $26,927 based on the present value calculation, same as before. Now let's see how different actual fair values impact the accounting, focusing on the outcome and why. Scenario 1. Fair value is $510,000. The bond's original cost, amortized cost here, is $500,000. The fair value is $510,000.
So it's actually worth more than cost, despite the expected credit issue.
Right. Even though we calculated an expected credit loss based on future cash flows, the current market is valuing this bond above its cost. Therefore, no credit loss is recognized in net income. Instead, Fox Inc. would recognize a $10,000 unrealized gain, the $510 fair value minus the $500 K cost, directly in OCI, reflecting the positive market movement for this available-for-sale asset. The market value trumps the calculated credit loss in this case for the income statement impact. Scenario 2. Fair value is $480,000. The bond's cost is $500,000. The fair value is $480,000. The expected credit loss is still calculated at $26,927. However, the fair value is only $20,000 below cost, $580K on it.
Okay, so the market decline is less than the calculated credit loss.
Exactly. In this situation, the credit loss recognized in net income is limited to that $20,000 decline in fair value below cost. The market hasn't declined enough to trigger the full expected credit loss as an income statement hit. So the income statement will show only a $20,000 credit loss expense. Scenario 3, fair value is $450,000. The bond's cost is $500,000. The fair value is $450,000, so it's $50,000 below cost. The expected credit loss remains $26,927.
Now the market decline is more than the expected credit loss.
Right. Here, the credit loss hitting net income is still limited to the full expected credit loss amount, which is $26,927. This is the portion of the total decline deemed due to specific credit risk. The remaining difference, the total $50,000 fair value decline minus the $26,927 credit loss, which comes out to $23,073, is recognized as an unrealized loss in OCI.
So the loss gets split. $26,927 to net income for credit, $23,073 to OCI for the rest of the market drop.
Precisely. This additional loss is considered a market-driven decline beyond the specific expected credit impairment. So the loss is allocated, part hits net income for credit risk, and the rest goes to OCI, reflecting broader market changes.
This really highlights how the classification affects where the pain of a loss is felt on the financial statements. For AFS, the market value plays a huge role in how impairment is recognized, potentially spreading the impact between net income and other comprehensive income, giving a much more nuanced picture of where the value decline is actually coming from. It's a critical distinction for investors to grasp. Hashtag 3.7 sale of debt securities.
Okay, so what happens when a debt security from any category is actually sold? Well, the result is a realized gain or loss. And this is always recognized in net income for that period.
Always net income for realized gains losses.
Always. This is the definitive final profit or loss on the investment for the company. And of course, any valuation allowance or fair value adjustment account previously used for the security must also be removed, since the asset is no longer on the books. For trading securities, the realized gain or loss is simply the difference between the selling price and its adjusted cost, or carrying value, right before sale. Because unrealized gains and losses for trading securities were already hitting net income as they occurred.
Right, we established that.
The income statement has effectively captured all the fair value changes up to the point of sale. So the final realized gain or loss on sale simply adjusts for any remaining difference between the carrying value and the sale price. Now, for available for sale securities, this is where something important called recycling happens.
Recycling seems environmentally friendly.
Well, in an accounting sense, maybe. The realized gain or loss is calculated as the difference between the selling price and the original cost of the security. But crucially, any unrealized gains or losses that were previously recorded and were sitting in accumulated income, other comprehensive income, OCI, for that security must be reversed at the time the security is sold.
Okay, why the reversal?
Because OCI is essentially a temporary holding place for these unrealized amounts for AFS securities. When the security is sold, the gain or loss becomes realized, and it needs to be fully reflected in net income. So the OCI amount is effectively recycled. It's moved out of OCI and into the calculation of the realized gain or loss that hits the income statement. This ensures the full economic impact of the investment's entire life, from purchase to sale, eventually passes through the income statement.
This is a key difference for AFS. You have to clean up that OCI amount when you sell, ensuring that the final realized gain or loss, encompassing all the value changes from purchase to sale, is correctly reflected in net income. It makes sense because eventually all gains and losses should pass through the income statement, giving a complete picture of the investment's performance over its life. All right, let's switch gears now from debt, where you're essentially a lender, to ownership equity investments. This is about buying a piece of a company, right? And I assume it comes with a different set of rules and considerations for how it's valued and reported. It feels like a completely different kind of financial relationship. Hashtag tech 4.1. What are equity securities?
You're right, it is a different relationship. An equity security represents an ownership interest in an enterprise, or sometimes the right to acquire or dispose of an ownership interest at fixed or determinable prices. Essentially, when you invest in an equity security, you're buying a piece of the company with all the associated rights, like potentially voting rights and risks of ownership. You're participating in its growth or potentially its decline. Our source clarifies what's included in this definition. First and most obviously, ownership shares. This is your common stock, preferred stock, and other forms of capital stock. These directly represent a fractional ownership in the company and the right to, say, vote or receive dividends.
Standard stock.
Right. Second, rights to acquire ownership shares are also included. Think things like stock warrants, which give the holder the right to purchase stock at a specified price. Stock rights, typically issued to existing shareholders, allowing them to buy more shares, often at a discount. And call options, which provide the buyer the right, but not obligation, to purchase a stock at a specified price. These instruments give you the ability to buy shares under certain conditions, potentially at a profit. And third, rights to dispose of ownership shares, primarily put options, which give you the ability to sell shares at a specified price, often used for hedging against price declines.
So options and warrants count too.
Yes, if they relate to ownership shares. However, the source also clearly lists what equity securities do not include, which is equally important to avoid misclassification. These exclusions are preferred stock that is redeemable at the option of the investor, or stock that must be redeemed by the issuer.
Ah, like the redeemable preferred we said was like debt.
Exactly. Because those have debt-like characteristics, implying an obligation to repay capital rather than a perpetual ownership stake. Also excluded is treasury stock, that's a company's own stock, that it repurchased and is holding. It's not an investment in another entity. And finally, convertible bonds.
Right, debt until converted.
Correct. They are debt instruments even if they have an equity conversion feature until they are actually converted into stock. Understanding these distinctions is really key to proper accounting. Hashtag 4.2 classification, generally fair value through net income, FETNI. Now, unlike debt securities with their three distinct classification categories based on intent, equity securities are generally simpler in their classification. They are typically carried at fair value through net income, FETNI.
FVTNI. So market value changes go straight to the income statement.
That's exactly right. Fair value changes, whether they are gains or losses, directly impact the company's net income in the period they occur. This generally reflects the highly liquid and actively traded nature of many equity investments, where market price fluctuations are considered a direct part of the company's current financial performance. It's like having a live feed of your investment's daily market value directly reflected in your quarterly profits.
Oh, okay. Simpler than debt then. Any exceptions?
Yes, there are a few main exceptions to this general rule. Investments accounted for under the equity method, that's the one used when an investor has significant influence over the investee, typically owning 20–50%, and can't just trade the shares freely. Also, consolidated investees where the investor has control, usually over 50% ownership, and the financial statements are actually merged. And the third exception is when a practicability exception is applied, which we should probably talk about next. Hashtag tech 4.3 practicability exception, when fair value is hard to find.
That makes sense for publicly traded companies where you can just look up the stock price. But what if an equity investment isn't publicly traded? Maybe it's a startup or a private company. And it's really hard, maybe impossible, to figure out its fair value. How do companies account for those situations where a readily determinable market price simply doesn't exist? That sounds like a real challenge for our financial detective.
It is a challenge, and that's precisely where the practicability exception comes in. It acknowledges that for some equity investments, particularly those in private companies or maybe very thinly traded ventures, obtaining a readily determinable fair value on an ongoing basis can be extremely difficult, if not impossible. So this exception allows an entity to measure such an equity investment at its cost, minus any impairment charges that might have occurred, plus or minus any observable price changes from identical or similar investments from the same issuer that happened in orderly transactions.
Observable price changes, like if someone else bought shares recently.
Exactly. If there's a recent private sale of a comparable block of shares from that same company. That transaction price can be used as evidence to adjust the carrying value up or down from the original cost. This exception is specifically for equity investments that do not have a readily determinable fair value. However, it's important to note that certain types of entities cannot use this exception because their business models inherently require more rigorous fair value accounting. Think broker-dealers in securities, investment companies, or maybe post-retirement benefit plans.
Why not them?
Well, for these organizations, providing fair value information is fundamental to their operations and the information they provide to their own stakeholders or beneficiaries. So the exception doesn't apply. They are effectively mandated to find a reliable fair value somehow, perhaps using valuation models.
So if it's a private company or a niche investment, there's a way to value it without a public market price using cost as a base, but it's not a free pass to ignore market realities or potential value changes if there are observable signals. It's a practical solution to a measurement challenge, but it still tries to achieve relevance and reliability in the absence of a liquid market. Hashtag 4.4 valuation FVTNI is the standard.
Right. So just to reiterate, putting aside the practicability exception and the equity method consolidation cases, equity securities are generally reported at fair value through net income, FVTNI. This means that unrealized holding gains and losses on these equity securities, those paper gains or losses that result from changes in the market price before the security is actually sold, are included in earnings as they occur.
So very similar to trading debt securities in that respect.
Exactly the same treatment for unrealized gains and losses as trading debt securities. It's an immediate recognition in earnings. This approach makes a company's net income potentially quite volatile, highly responsive to the day-to-day or period-to-period performance of its equity investments in the stock market. Hashtag 4.5 income from investments in equity securities. Okay, what about income? Well, dividend income from an equity security investment is generally recognized in net income. Pretty straightforward.
Dividends received, income, seems simple enough.
Usually, yes, unless that dividend is classified as a liquidating dividend. This is a very important distinction you need to grasp. For a normal, non-liquidating dividend, when cash is received from a dividend, the entry is simple. Increase cash, increase dividend income on the income statement. This signifies that the dividend is a distribution of the investee's actual accumulated earnings or profits. A liquidating dividend, however, is a bit more complex and represents a crucial difference in substance. It's defined as a distribution that exceeds the investor's share of the investee's retained earnings.
Exceeds retained earnings, so they're paying out more than their accumulated profits.
Essentially, yes. The company is distributing more than its accumulated profits would support on a per-share basis for that investor. This means part of the distribution is considered a return of capital rather than pure income. And this return of capital actually decreases the investor's original cost basis in the investment. It's as if a portion of their initial investment is being returned to them rather than a new profit being generated.
Okay, that's a big difference. Can we see an example?
Absolutely.
Okay.
Let's illustrate this with example 3. Facts. ABC Corporation owns a 10% interest in XYZ Corporation. During the current year, XYZ Corp paid a total dividend of $10 million. At the time the dividend was declared, XYZ had total retained earnings of $8,000 on its balance sheet. Solution. First, how much cash does ABC receive? They own 10%, so they get 10% of the total $10 million dividend. That's $1 million cash received.
Okay, $1 million in cash.
Right. Next, we figure out how much of that is actual dividend income. ABC's share of XYZ's retained earnings, the actual accumulated income portion available for distribution, is $8 million, multiplied by their 10% ownership, which equals $800,000. This $800,000 is the legitimate dividend income that goes to ABC's income statement. Now, the difference between the total cash dividend received, $1 million, and the income portion, $800,000, is $200,000. This $200,000 is the liquidating portion.
The return of capital part.
Exactly. It's considered a return of ABC's capital, not income, and therefore it reduces ABC's investment account for XYZ on their balance sheet by that $200,000 amount.
This is a fascinating distinction. Not all dividends are pure income that boosts your bottom line. Some of it might actually be returning your initial investment, which is crucial for investors to understand, as it impacts the book value of their investment over time. It's less about profit and more about capital recovery. In that case, almost like getting a partial refund on your original purchase price. Hashtag 4.6 impairment for practicability exception.
Now, what about impairment for those equity investments where we're using the practicability exception because fair value isn't readily determinable? How do we know if their value has dropped permanently? Since we don't have a reliable market price, impairment for these is assessed based on qualitative indicators. Basically, an entity needs to look for red flags to determine if impairment exists. These indicators are crucial because there isn't that clear market signal telling you the value has dropped. The source outlines several key qualitative indicators to consider. One is heightened concerns about the investee's ability to continue as a going concern.
Like they might go bankrupt.
Exactly. Signs like non-compliance with capital requirements or debt covenants, significant deficiencies in working capital, or maybe consistently burning through cash with negative operating cash flows. These indicate fundamental problems with the investee's financial viability, suggesting the investment might not be worth what it's carried at on the books. Another indicator involves significant and adverse changes in the external environment, the industry, the geographic area they operate in, the technology they rely on, or maybe the regulatory or economic climate.
Things outside their control.
Right. A sudden shift in consumer preferences, making their product obsolete. New disruptive technology emerging, or maybe stricter environmental regulations could severely impact the company's operations and future prospects, signaling a potential permanent decline in your investment's value. We also look for internal signs. A significant decline in the investee's own earnings, business prospects, asset quality, or maybe their credit rating. A sudden drop in sales, significant operating losses, deteriorating assets, or a downgrade by a credit rating agency would strongly signal potential impairment. And finally, a pretty direct signal. Offers to buy from the investee, or maybe willingness to sell on the part of the investee, the same or a similar investment for substantially less than the investor's carrying value. This provides a direct market signal, even if it's informal or private, that the value is likely lower than what the investor has on their books.
So you look at all these factors together.
Yes. If this qualitative assessment indicates that impairment likely exists based on these factors, then the cost basis of the security is written down to its estimated fair value. Even if that fair value is hard to determine precisely, an estimate must be made. And importantly, the amount of that write-down is accounted for as a realized loss and included in earnings.
Realized loss, so straight to the income statement again.
Correct. It directly hits the income statement and reduces profitability for the period, reflecting the assessment of a permanent decline in value, even if no cash changed hands and no active market exists. Hashtag 4.7 sale of security. Okay, finally, what happens when an equity security is sold? How that sale is accounted for depends on how its fair value changes were previously reported. If all changes in its fair value have already been reported in earnings as unrealized gains or losses, which is the standard case for equity securities accounted for as fair value through net income, FET&I.
Right, the usual method.
Then the sale itself does not give rise to a new gain or loss on the income statement at the time of sale.
Wait, no gain or loss on sale. Why not?
Because the gains and losses were already recognized period by period as the fair value changed. The carrying value on the books already reflects the fair value right before sale. So the cash received from the sale simply replaces the asset's current book value on the balance sheet. The income effect already happened in prior periods. However, if an entity has not recorded the equity securities change in fair value up to the point of sale, for example, if they were using that practicability exception because fair value wasn't readily determinable,
The exception case.
then a gain or loss is recorded at the time of sale. This gain or loss equals the difference between the selling price and the adjusted cost. The adjusted cost is the original cost plus or minus any of those observable price change adjustments previously recognized under the practicability exception. So in this scenario, the act of selling finally crystallizes the full profit or loss and brings it to the income statement.
Okay, all this detailed accounting. It isn't just for the accountants locked away in a back room, right? It's about transparency for investors, for lenders, for the public, so they can actually understand a company's financial position and the risks it's taking. So, beyond the internal accounting, what information must companies actually share about these financial instruments in their public reports? What are the required disclosures, and why are they so crucial for our financial detective work?
You're absolutely right. Disclosures are vital for financial transparency. They're really the map that helps you navigate the potentially complex financial landscape presented in the main statements. They provide crucial context. For securities classified as available for sale and, separately, for held to maturity, companies must disclose specific information, usually in the notes to their financial statements. This includes the aggregate fair value of these investments, giving you a quick snapshot of their current total market worth. They must also disclose the gross unrealized holding gains and losses, that's the total paper gains and total paper losses, before any netting.
Wait, gross. Why not just the net amount?
Showing the gross amounts gives you a clearer picture of the potential volatility and the two-sided swings inherent in these portfolios. A small net unrealized gain could be hiding very large gross gains and almost equally large gross losses, indicating more risk than the net number suggests. Furthermore, they need to report the amortized cost basis by major security type. This details how much was originally paid for them, adjusted for any premium or discount amortization, and it's usually categorized by type, like corporate bonds, government bonds, mortgage-backed securities, etc. This helps you understand the initial investment and the composition of the portfolio. And crucially for debt, they must provide information about contractual maturities. This usually breaks down when these debt securities are due to be repaid, often into time buckets like due within 1 year, due in 1 to 5 years, due in 10 years, due after 10 years.
That seems vital for assessing liquidity risk.
Absolutely. It helps you understand the timing of expected future cash inflows for the company from these investments. Hashtag 5.2 disclosures for investments in equity securities. Now, for investments in equity securities, entities must disclose the portion of unrealized gains and losses recognized in earnings during the period that relates to equity securities still held at the end of the reporting period.
Okay, that sounds a bit specific. How does that work?
It's calculated by taking the total net gains and losses recognized during the period on all equity securities, those heading FET&I, and then subtracting any net gains and losses recognized during that same period on equity securities that were sold during that period. The purpose is to help users differentiate between the gains and losses generated from actively trading securities that were sold, which are now effectively realized or part of a realized amount, and the ongoing unrealized gains or losses related to the securities still held in the portfolio at year-end. It helps you see the current market pulse on the company's existing equity portfolio. Hashtag 5.3 fair value disclosures. Fair value disclosures are really a cornerstone of modern financial reporting, especially for financial instruments. They provide crucial context for how assets and liabilities are measured. All entities, public and private, must disclose all financial assets and liabilities presented on their balance sheet, or disclose this info in the notes, grouped by their measurement category. Are they accounted for at fair value through net income, FET&I, through other comprehensive income, OCI, or at amortized cost?
So you can see clearly how each group is measured.
Exactly. And for financial assets, the specific form of the asset, debt, or equity must also be disclosed within those categories. Now, public business entities, PBEs, generally larger publicly traded companies, have an additional, very important detailed requirement. They must provide fair value information regarding the classification level within the fair value hierarchy.
The hierarchy. Levels 1, 2, and 3.
That's the one. Think of these levels as indicating the reliability or objectivity of the fair value measurement. Level 1 is the gold standard. You're valuing the instrument based on a quoted price in an active market for an identical asset or liability. Think checking the price of Apple stock on the NYSE right now. Easily observable, highly reliable. Level 2 is still based on observable inputs, but maybe not a direct quote for the identical item. It could be quoted prices for similar assets in active markets, or prices for identical assets in markets that aren't considered active, or maybe inputs other than quoted prices that are observable, like interest rates or yield curves. So still pretty reliable inputs. But level 3, that's where things get significantly more subjective. Level 3 inputs are unobservable. The valuation relies more on internal models, management estimates, and assumptions because there's no readily available market data.
So level 3 values have more judgment baked in.
A lot more judgment. It's absolutely crucial for you as the financial detective to know which level a company is using for its significant fair value measurements, especially level 3. It tells you a lot about the potential reliability and subjectivity of that fair value number. High level 3 balances warrant more scrutiny. Now, even for assets and liabilities measured at amortized cost on the balance sheet, their fair value should generally still be disclosed in the notes. This is usually based on the exit price, what they could theoretically be sold for. This helps users understand the potential market value, even if it's not the primary measurement basis on the balance sheet.
Giving you both perspectives.
Right. There are some exceptions to this disclosure, however. Things like short-term payables and receivables due within 1 year, certain deposit liabilities with no defined maturities, and, as we mentioned, those equity investments reported under the practicability exception because their fair value isn't readily determinable by definition. And for entities that have elected the practicability exception for certain equity investments, they have specific disclosure requirements. They must disclose the carrying amount of all such investments, any impairment charges they recognize during the reporting period, and the amount of any upward or downward adjustments made to the carrying amount due to those observable price changes we talked about. trying to reflect fair value changes as best they can. Hashtag 5.4 concentrations of credit risk. Okay, shifting gears slightly. Entities must also disclose all significant concentrations of credit risk arising from all their financial instruments.
Credit risk, again, the risk the other party won't pay. What's a concentration?
A concentration happens when a company has a substantial amount of its financial contracts tied up with one specific counterparty, or maybe with a group of counterparties that are all in the same industry or the same geographic region, or that have similar economic characteristics that would cause their ability to meet contractual obligations to be similarly affected by changes in economic or other conditions.
Like having all your loans out to companies in one cyclical industry?
Exactly. Or maybe a large portion of your sales revenue comes from just one or two major customers. If that industry hits a downturn, or that one customer goes bankrupt, the company faces a disproportionately large potential loss. This disclosure helps users understand where a company's counterparty risk is concentrated and how exposed they might be to a single point of failure or a localized economic shock. Under U.S. GAAP, these disclosures apply to essentially all entities, although there's a specific exception for smaller non-public entities that meet certain criteria. Hashtag 5.5 market risk. Finally, there's market risk. This is the possibility of loss arising from changes in market prices or market rates that are not due to the other party's failure to perform. That's credit risk, but rather due to changes in overall economic circumstances.
So things like interest rates changing or currency exchange rates fluctuating?
Precisely. Or changes in commodity prices or overall stock market levels. Under U.S. GAAP, all entities are encouraged, but importantly, not required, to disclose quantitative information about the market risk inherent in their financial instruments. This disclosure, if a company chooses to provide it, should ideally be consistent with how they actually manage those risks internally. It might offer insight into their risk management strategies, maybe using techniques like value at risk, BDR analysis, or sensitivity analysis, showing how they prepare for or hedge against broader economic shifts.
So credit risk is about who you lend to or transact with and their specific ability to pay you back. Market risk is broader. It's about how external economic tides can lift or sink your boat, regardless of the individual borrower's creditworthiness. These disclosures, whether required like credit risk concentration or just encourage like quantitative market risk, give investors a crucial lens into a company's financial exposures and how effectively they're managing these different types of risks. It's how you spot potential landmines that might not be obvious just looking at the main financial statements. Okay, we have covered a lot of ground here. Definitions, classifications, valuation rules, impairment, disclosures. Now let's try to see how all of this plays out in practice with a comprehensive scenario. We can use the information provided in example 4 for Fox Inc.'s portfolio. This should help bring all the concepts together and help you visualize the numbers without getting lost in every single computation. Let's focus on why these numbers appear where they do based on the rules we discussed.
Indeed. A practical example is always good. So we have Fox Inc.'s portfolio of marketable investments for the year ended December 31st, year 2. We have their original cost, fair values from the end of the prior year, any purchases or sales during year 2, and the current fair values at the end of year 2. And importantly, the example states there are no expected credit losses on Fox's debt investments for this particular scenario, which simplifies the impairment aspect and lets us focus squarely on the classification and valuation nuances we've been talking about. Okay, let's look at the requirements step by step. 1. Calculate the carrying amount of each security on the balance sheet at December 34th, year 2. Where do these end up on the balance sheet? First, security ABC. It's a held-to-maturity debt security. Its original cost was $100,000.
Okay, HTM, so amortized costs, right? No fair value.
Exactly. Because it's HTM and Fox Inc., presumably has the positive intent and ability to hold it to maturity and no credit losses are expected, its value on the balance sheet stays at its original amortized cost, which is $100,000 in this case since it was bought at par. The fact that its fair value was $95,000 at the end of year 1, or whatever it is at the end of year 2, isn't used for its carrying amount on the balance sheet. HTM securities are not marked to market. It provides that stable, predictable balance sheet value. Next, security DEF. This is an equity security.
Equity, so generally FBT&I, fair value through net income.
Correct. Equity securities are generally carried at fair value through net income. The problem states its fair value at December 34, year 2 is $155,000. So its year-end carrying amount on the balance sheet is precisely $155,000, reflecting its current market value. Now, security GHI. This one isn't available for sale debt security, but the key detail here is that it was sold during year 2.
Sold, so it's gone.
It's gone. Therefore, its carrying amount on the balance sheet at year-end is $0. It's no longer part of Fox Inc.'s portfolio. Finally, security JKL. This is another available for sale debt security.
AFS debt. Also, fair value, right? Since
Yeah.
there are no credit losses mentioned here.
Right. AFS debt investments are reported at fair value when there are no expected credit losses impacting the valuation method itself, though impairment would still be assessed if needed. Its fair value at December 34, year 2, is given as $160,000. So its carrying amount on the balance sheet is $160,000. Calculate any realized gain or loss recognized in year 2 net income. Which transactions hit the income statement as realized? This primarily applies to security GHI, the one that was sold. It was sold during year 2 for $175,000, and its original cost was $190,000.
Sold for less than cost, so a loss.
Yes. The realized loss on sale is the selling price, $175,000, minus the original cost, $190,000, which yields a $15,000 realized loss. This $15,000 realized loss directly impacts net income for year 2. But crucially, remember that security GHI was an AFS security. This means its previous unrealized losses were sitting in other comprehensive income, OCI. Looking back at the data, December 31, year 1, its fair value was $165,000, while its cost was $190,000. So there was an accumulated unrealized loss of $25,000. $165K FE, $190K cost, sitting in OCI from the previous year.
Ah, the recycling part.
It's exactly. Upon the sale of the security in year 2, this prior accumulated unrealized loss of $25,000 must be reversed out of OCI. This reversal is part of the overall journal entry for the sale, and it ensures that the full economic loss, $15,000 based on cost, is recognized in net income in the year of sale, while clearing out the related OCI balance. 3. Calculate any unrealized gain or loss recognized in year 2 net income. What paper gains or losses hit net income this year? This calculation focuses on security DEF, which is an equity security. As we established, equity securities are generally accounted for as fair value through net income, FVTNI. At December 31, year 1, its fair value and carrying value was $160,000. At December 31, year 2, its fair value was $155,000.
So its value went down by $5,000.
Right. The unrealized loss for the current period is the current fair value, $155,000, minus the prior fair value, $160,000, which result in a $5,000 unrealized loss. This $5,000 unrealized loss on the equity investment is reported directly in net income for year 2. It reflects the immediate impact of its market value change on the company's profitability for the period. 4. Calculate any unrealized gain or loss, representing the current year change, to be recognized in year 2. Other comprehensive income. What changed in OCI this year? Okay, this calculation focuses specifically on the change in OCI during year 2 related to the AFS debt securities. Let's start with security GHI. As we just discussed, at December 31, year 1, there was an accumulated unrealized loss of $25,000 in OCI related to this security. When GHI was sold in year 2, this prior accumulated unrealized loss of $25,000 is reversed out of OCI.
So OCI goes up by $25,000 because of that reversal.
Exactly. The reversal contributes a positive $25,000 change to the current year's OCI activity, effectively clearing out the accumulated amount for GHI as the investment has now been sold. Now let's look at security JKL, the AFS security that was not sold. At December 31st, year 1, its fair value was $175,000 and its cost was $170,000. So there was an accumulated unrealized gain of $5,000 sitting in OCI for JKL from the prior year.
Okay, it started with a $5K gain in OCI.
Right. Now at December 31, year 2, the fair value of JKL is given as $160,000, while its original cost remains $170,000. This means that at the end of year 2, there is now a total accumulated unrealized loss of $10,000 for JKL. 160K FE, 170K cost.
So it went from a $5 gain to a $10K loss in accumulated OCI.
Precisely. Since there was already a $5,000 gain in accumulated OCI from the prior year, the change in OCI specifically during year 2 for JKL is a $15,000 loss. It takes the accumulated OCI balance for JKL from positive $5,000 down to negative $10,000. That thing is a $15,000 decrease. So the net impact on OCI recognized in year 2 is the combination of these two changes. The reversal from selling GHI, which is a $25,000 positive gain to OCI, plus the current year change from JKL, which was a $15,000 negative change loss to OCI.
$25,000 gain minus $15,000 loss.
Equals a net unrealized gain of $10,000 recognized in other comprehensive income for year 2.
Wow, this example truly ties everything together, showing how different classifications impact net income, OCI, and the balance sheet in very specific numerical ways. It demonstrates exactly why understanding these rules is so vital for anyone looking at a company's financial statements. The classification decision directly impacts how financial performance and position are presented, almost like seeing the different chambers of the company's financial heart beating. Hashtag tagged, hashtag outro. And there you have it, a really deep dive into the fascinating and sometimes complex world of financial instruments. From defining what they fundamentally are to understanding the crucial nuances of their classification, valuation, impairment, and the vital impact all of this has on financial statements, we've unpacked a truly essential area of finance. Remember, as we saw, it's not just about knowing the terms like AFS or FVT&I, but really understanding the why behind the accounting choices companies make and how those choices translate directly into the numbers you see. It's about becoming that financial detective, looking for the signals hidden within the details.
Absolutely. This knowledge really empowers you to look beyond just the final numbers on a balance sheet or income statement and truly begin to understand the story a company's financial statements are trying to tell you. So when you next look at a company's financial statements, maybe ask yourself, okay, how does understanding these distinctions about how they classify and value their debt and equity investments change the questions I should be asking about their financial health, their risk profile, and maybe even their investment strategy? Knowing whether those unrealized gains or losses are hitting net income directly or being parked in OCI, or if a major asset is held at amortized cost versus a potentially volatile fair value. Well, that offers profound insights into management's intent, the actual volatility within the business, and the risks they face. This deeper understanding will truly set you apart in your financial literacy journey.
That's a fantastic thought to leave you with. Keep that curiosity burning. We really hope this deep dive helps you navigate the financial world with more confidence and perhaps a newfound appreciation for the many layers of information embedded within financial statements. Until next time, keep learning, keep exploring.